Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kessling, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everybody, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Fifth Era Partners co-founder and CEO, Matthew Merle. Fifth Era Partners is a specialized asset manager providing access to exponential technologies that are transforming our world. On the show, we discuss whether he expects a new crypto bull market and what will drive it, which area of AI is overhyped and which is underappreciated that isn't consensus yet, his top investment theme for the next 5 years, and more. So with no further ado, here's our show on investing at the edge of AI and blockchain with Fifth Era CEO Matthew Merle. Matthew, it's awesome to have you on the show, calling in from San Francisco. A bit rainy out there, but other than that, how are you today?
Fantastic, and it's great to be with the two of you, Julian and Michael. Looking forward to talking to your audience.
Yeah, and specifically, we're going to focus on blockchain and AI, your focus at Fifth Era. Now, prior to getting into those sectors, which, I mean, there's a ton of stuff happening. It's quite frankly, could be overwhelming and difficult to keep up with all the innovation happening, but wanted to look into kind of what kicked things off in the first place, specifically with respect to blockchain and crypto. And the first invention there was Bitcoin. I always like to hear people's sort of first Bitcoin story. I understand you're fairly early to the space. So why don't you tell us how you first discovered Bitcoin and why it clicked for you?
I'm happy to, Julian, and I'll give you the longer version. But you know, we'd been internet, fintech, and digital content investors for 20 or so years before we saw Satoshi's white paper. And we'd also been very focused on payments and banking and digitalization. Alison Davis, who is my partner, Alison had been on the boards of First Data and Fiserv, City National Bank and others. And she'd been CFO of BGI, BlackRock. It's now BlackRock, when we launched iShares and so on. And so for us, the digitalization of financial services was sort of something we'd been working on for a long, long time. And we sort of knew that it was harder than it sounded, and that the internet, whilst doing a great job at digitalizing communications and content, was struggling with value. And full kudos, it was Alison who really first saw the light bulb turn on. She saw the Satoshi Nakamoto white paper, peer-to-peer cash over the internet, read it, understood it, went on a voyage of discovery, met a bunch of people, Brock Pierce, Bart and Brad Stevens at Blockchain Capital and others. But really for her, the light bulb that went on, Julian, was that she saw that it was a working digital money that was, you know, internet native, but also that it was software. And the implication was if one was working, then we could have as many digital monies as we wanted or needed. And by inference, we could also digitalize any other asset, including commodities, securities, and so on. So she saw that very early. I took it a couple more years to get it. And the reason, and I think for some people, they're still struggling. But for me, it was because I just spent 30 years with Google and Microsoft and eBay and a host of others standing up the internet. I was a consultant back then with big consulting firms, senior partner. And I was hearing the blockchain crowd saying, this is going to be bigger than the internet. And I couldn't imagine anything that could substitute the internet or be bigger than the internet. And it took me about 2 years to realize that blockchain is not a substitute for the internet. It's a complementary technology that provides a full stack solution when you combine it into the internet tech stack. It's a full stack solution for the movement of value over the internet. And what I'm saying now, some of your audience will say, well, of course, but 12 years ago, we weren't. We were just talking about Bitcoin. We weren't really talking about what's now happening. And I'll stop there, Julian. It's a long answer, but that's sort of our genesis story.
In 2014, you didn't have Ethereum and stablecoins and all these sort of new growth segments of the market. But with that, as it stands, April 2026, we're in a bit of a crypto bear market. Obviously, had a huge run into last year, really off the back of Bitcoin and crypto going mainstream. I believe one of the main drivers there was ETFs, crypto ETFs, which drove a lot of adoption, took Bitcoin, north of $100,000 per Bitcoin, which was just a significant bull run there, effectively 4xing, come off quite a bit, 30-40%. Now with that, the space is notoriously cyclical. Do you think crypto has another bull market in it? And if so, what do you think will be the driver?
Yeah. So, Julian, I feel like I was around in the 90s rolling out internet technology, helping, as I mentioned, big companies figure out how to really take advantage of the digitalization of communications from content, help launch bankamerica.com, gap.com, and others. And back in those days, we had a period when all you needed to do was add .com to your name and everyone thought you were amazing. And then we had the .com crash and everyone said it's over. And of course, they were both wrong. I mean, this is innovation investing. So there's failure is going to be the norm. A small number of things are going to change the world. And it doesn't really, the fundamentals do not cycle. They just slowly and inevitably take over the world. The issue that we have is that investors, through their own behaviors and actions, create ups and downs and volatility. And that's what really the cycles that we see. So on the fundamental level, digital finance has never looked stronger. Blockchain is in the enabling technology the world is using. And all of the curves are upwards and to the right in terms of the fundamentals. Digital wallets enforce daily, monthly average usage of those wallets, transaction volumes over them, purchases, assets that have been digitalized, everything's going up. So now you ask me a question, will we cycle through ups and downs and will price get ahead or value get ahead of reality? And then will it come crashing down? I think that's the human condition. And it's not for the faint-hearted. If you're an investor in innovation, it comes with the territory. And the challenge that we've got, I think, in our space is that a lot of public market investors came into what was essentially a venture environment, and now they're scared away because they didn't appreciate that risk was at the 78-80%, failure was at the 70-80% level in the public markets. Public liquid traded tokens had existential risk written all over them, and we're seeing that play out. So, yeah, unfortunately, the ups and downs come with the space, but we are as committed to blockchain investing as we've ever been.
That makes sense. And it's coming up 20 years now with the advent of the Bitcoin white paper. And, I always thought that, as much as blockchain technology is exciting, that Bitcoin has always been sort of the killer app. But with that, kind of looking forward, what are your thoughts on kind of the most exciting area of crypto and blockchain investing? Does that continue to be Bitcoin, which, over the past whatever time frame it is, over the long term, has just provided absolutely exceptional returns as long as you're measuring over a year? What space are you excited about within blockchain and crypto?
Yeah, thanks, Julian. Well, I'm a little bit of a fundamentalist around the notion that nothing deserves to be a killer app unless it fundamentally meets consumer needs in profound ways. And so the question isn't, is X or Y likely to be the winner? The question is, what are consumer needs that we need to meet and who's meeting them best? And what I loved about Satoshi's white paper was it was a peer-to-peer cash that works over the internet, and I think that that's the holy grail of payments and finance. And that if Bitcoin accomplishes that, it deserves absolutely to be one of the small numbers of monies in the world that we all use. The challenge for the Bitcoin core developers is we haven't quite realized Satoshi's vision. Most people in the world use Bitcoin as a store of value, but we don't really use it for payments. Now, I know that Stripe and Block and others are turning on that functionality, but if we're honest about it, most of us do not use Bitcoin for payments. And in most of the world, people are using Tether, stable coins for payments, which is I would say it's an adjacent innovation, the tokenization of the dollar, but it doesn't have all of the same characteristics of Bitcoin, which I value. So for me, at least, the monetary system of Bitcoin is superior to that of the US dollar for all the reasons the scarcity and the inability for government officials to run rampant and print it like crazy. So that's good. But the bad part of Bitcoin is we just don't have it working yet as a peer-to-peer cash over the internet. And I'd like to see it get there. And I think if it did, it would have the long-term possibility of becoming, if not the global reserve currency, then certainly one of a small number. So I said a lot there. I'm happy to go back and unpack what we just said. I love Bitcoin. I believe in its future, but only if we continue to make it better. And this is a competitive race. So that's the other point. You can't rest on your laurels. You can't say, well, I'm better at selling books than anyone else, so I don't need to innovate, because you'd just end up being an online bookseller and Amazon would have cruised past you, right? So you've got to carry on innovating and you've got to carry on making your solution better, because consumer needs will also change over time. And right now, consumers are saying, well, I'm sort of okay just using Bitcoin as a store of value. Later on, they'll say that's insufficient. It's got to be more. Show me how I actually use it in my everyday life. So anyhow, number one, I do believe Bitcoin has a long-term role. Number two, we need to make it better. Number three, we can't rest on our laurels. And number four, other great innovators are innovating other things, including Tether or Circle or whatever. And some of those are right now more functional than Bitcoin.
Something that you mentioned within that was tokenization. And so I'm curious for your thoughts, given your firm's background and involvement in the early days of BlackRock and iShares, specifically tokenization of ETFs. That's been something that has been talked about, 24-hour trading. What are your opinions on that?
Yes, thank you. Great question. And I did already hint. So let me just clarify one thing. I had a different role. It wasn't Fifth Era. I worked with Lee Cranefuss on the question of can we take webs and convert them into iShares as a strategy consultant. And then Alison at the time became CFO and incubated and worked with the iShares team to scale it up. So I just want to clarify that. It wasn't Fifth Era that was around back then. In terms of your question, when we digitalized communications, which were things like letters and faxes, it was pretty clear what the benefits were. And today, none of us can imagine using faxes as our primary communication methodology, right? So I don't need to remind you of all of those benefits: faster, cheaper, easier to use, almost real time, but also very scalable. You can send a message to 100 people or 1,000 people, and you can save a copy automatically, and you can do all sorts of other things. When it comes to the movement of value, we are still right back where we were 30 years ago. It's very people intensive. It tends to be paper and process in 60 days to close. It costs a lot of money, to use your credit card, 26% APRs if you revolve. The costs, the time, the effort are very, very substantial. And that's before we talk about things like counterparty risk, where almost the entire world's financial system has to constantly work and spend a lot of money trying to counterparty risk, because we don't have real-time settlement. If we had closer to real-time settlement, we'd have less counterparty risk. So in that context, tokenization is a technology that allows us to digitalize the ownership record of an asset. And in so doing, we gain most of the benefits of an email, but it's attached to the movement of a of a title to an asset. And that is as profound a moment as the first time you tried to send an email, right? And most people haven't tried to buy and sell a digital security, right? But the point is, it's almost as easy to do it as it is to send an email. And the first time you ever sent an email, or for that matter, downloaded some digital music, you were blown away, right? We were all blown away when we first had our iPod moment or our iTunes moment. Well, that's how easy money is going to be. That's how easy financial services is going to become. And yet it's not going to happen quickly. So Julian says, look, it's almost 20 years since Satoshi wrote the white paper. Well, when I was a teenager, a long time ago, 50 years ago, all the milk was delivered in the UK by electrical vehicles, right? And here we are 50 years later, and there aren't that many electrical vehicles in America. We're still mostly combustion engines. So it takes time for superior technologies to roll out. And no one should think that we're going to digitalize all the world's value and all the world's assets in a week or a month or a year or 5 years. It's going to be a 50-year exit, but it's coming now. And it is inevitable. It's absolutely inevitable.
Yeah, I agree in terms of the tokenization of real-world assets being inevitable, and that trend is starting to pick up. Speaking of another trend these days, and another major focus area at Fifth Era, artificial intelligence, AI, which has seen just an absolutely incredible number of developments recently, particularly around agentic AI. There was the emergence of OpenClaw over the past, couple months, and Jensen Huang called that AI's iPhone moment. It's really allowing agentic AI to take another leap forward. And you've had Moltbook, which I was just sort of fascinated with, agentic AI having their own social media site, which was just really opened my eyes to the potential of AI agents. So with that, and all of the innovation in one of your focus areas being AI, do you see that as an area that's complementary to blockchain? Do you see them as fairly independent? I know one recent example I've seen is completely autonomous AI agents having their own crypto wallets and effectively being paid either in Bitcoin or stablecoins. What are your thoughts on kind of the opportunities in those segments?
Yeah, so that's great, Julian. You said a lot there. As a frame of reference for your audience, I would start by reminding you it's all software. There is some hardware too, but it's all software. So go back to what we talked about a moment ago and start off with the notion that people want to do things, and we can make those things easier to do, cheaper, quicker, more secure, safer, et cetera, with technology. And the technology we use isn't really the point. The point is that you get to do whatever it is you want to do in much, much easier, better ways. And almost no one listening to this, there's probably a few exceptions, but almost no one here can really understand, can really explain what TCP/IP or frame relay or HTTP really are. They use them every day, right, in the products they use. But if you ask them to have a detailed software-based conversation about what are the differences between these protocols or these standards or these technologies, most of us can't explain that. And we don't need to. It's all software. So when Andreessen said software is eating the world, he wasn't talking about a particular type of software. It wasn't sort of like, it's got to be mainframe enterprise software that's eating the world. It was just software's eating the world. And if you say, well, what goes into software? Well, down at the bottom, we have to have some computing capability and technology. We need to have some pretty heavy-duty software down there. We have databases. We have information that we then need to manage and process. And there's sort of a stack building up. There's middleware on top of it. There's applications on top of all of that. And in there somewhere, we always had the thought that we have intelligence. The intelligence was things like big data analytics, machine learning, and later on we gave it other names, algorithmic decision making, but we always knew it was there. We've known that for 40, 50 years. What we just had was not a profound shift to the notion that software is eating the world and software has a lot of components to it, of which one is intelligence, decision making. No, what we just had was a profound moment because it suddenly became very easy for us all to use it. And the intelligence got to a point where it could build upon itself, not only making ever better decisions or answering questions ever better, but also beginning to write software as well. And I think that is going back to an earlier conversation. That's sort of like iPod and iTunes were a UI UX upgrade that allowed everyone to download music and store it and carry it with them. It wasn't that you couldn't do it before, it's just it was really, really hard. Well, I think that what we just had occur was two things. One was a massive UI UX upgrade on the accessibility and usability of intelligent software. And then the other one I've already hinted at, which is the global constraints to software creation were twofold. Can you find a good software engineer? And secondly, how long does it take them to write the code? And now we've just 100, 1,000, 10,000x both of those dimensions. We've got artificial software developers who can write software pretty well and build upon what they see others writing, which is very iterative. And then they can do it blindingly fast. And so the rate of software improvement just went up incredibly steeply. And I think we haven't yet got to grips with that. We haven't yet got to grips with that in the sense we're still human beings thinking that you've got to hire a software engineer, lay out a work plan and get them to write code. The smart engineers are doing things blazingly fast right now. And I think that the rate of innovation is going to just be unbelievable. I can't even get my head around it.
Yeah, you're speaking for all of us. Just that rate of innovation and the new developments is just so fast. It's created so much uncertainty. There's the floating thesis that AI is going to kill software. News just yesterday that, potential new quantum algorithm out of Google could, kill the encryption in the Bitcoin blockchain, amongst others. And so just so much uncertainty, in addition to just all the rapid developments. And as that translates to the, traditional capital markets, the stock market, the past couple of years, we've seen some fairly large initial public offerings, IPOs, in both the crypto and the AI space. You had, for example, CoreWeave, large IPO. You had Circle, another big one. Now, what are your thoughts on kind of the potential for IPOs this year? We all hear that, potentially Anthropic and OpenAI are going to be huge ones. SpaceX, there's an AI angle there with XAI, one of the frontier labs as well. Is there an opportunity only for AI? Does crypto have an opportunity here as well?
Yes, so again, a lot of things there, Julian. I think the way I think about it is when we see profound innovation occurring, there are going to be winners and there are going to be losers. Most of the winners are going to be born new, disruptive, innovation-focused companies. And I know in crypto there may be projects, but putting that aside for a moment, let's just call them companies or enterprises. So most of the value unlocked by innovation will be captured by the disruptive new innovative companies. And the public markets is probably a good home for many of them. They deserve to be public because they're so good at what they're trying to do. And meanwhile, the public companies, well, I'll come back to that in a second. So that's the first point is we do have waves of innovation taking off. It's not a singular thing. It's life sciences, it's clean energy, it's the Internet of Things, it's AI, it's blockchain and digital finance. And all of the best companies in these innovations are now at a point, or many of them are, where they're saying, we're too big to be bought and we probably should be public. So let's prepare that way. And you are correct that there's been a lot of announcements. In my primary space, blockchain, I think we have about 30 late-stage unicorns all going through the traditional IPO path with names like Kraken and Uphold and so on. And then we also have a lot of de-SPAC mergers occurring as well. Now, there is the risk of irrational exuberance and valuations getting ahead of the discounted cash flow or the intrinsic value of those initiatives. And that is something that Wall Street has to get their heads around. But the other side of your question, Julian, I actually think is the more interesting one, which is what rights do any of the existing public companies have to claim that they're fit for purpose for the new world that's coming? And for those people who are equity analysts that are listening in, every discounted cash flow I've ever seen for a public company has most of the value in the terminal value.
Right.
And that's an extrapolation of the last year cash flow, which implicitly implies that you think that the company is going to continue to have a business and is going to continue to do the things that it's done. Because innovation is not something you've factored into the terminal value. So I don't think there's any industry at all that I could claim will be unchanged in 10 years' time and going on. I don't know that we'll have any combustion engines left in 10 years' time. I don't know that we'll be buying anything in a mortar rather than a clicks approach. I'm not sure that communications or computing by IBM or Oracle will make sense anymore. It's so fundamental. And so this is now we're talking about the biggest losers. Most value in the public markets today cannot be relied upon. And I think most discounted cash flow analysis is probably very wrong. And I think it's going to take a while for any equity analyst to have a clarity on how to value a incumbent company that's being disrupted by these new technologies. And we're beginning to see that ripple through. So it's sort of like you suddenly wake up and Fiserv's stock 50 or 60%, because one suddenly says, well, do we need merchant acquirers and so on in a stablecoin based world where we go peer to peer? Do we need all of that activity, all of these intermediaries and all of the rents they charge, and how's that going to play off? So again, a very long answer, Julian, but if I am not primarily a public market investor, but if I was, I would not only be interested in who's going to be a public company and trying to invest in them well ahead of their going public event, but I would also be thinking through, what's in plain view that is going to be disrupted and where is value going to get destroyed rapidly. And I wouldn't be shorting companies, but a lot of people like shorting companies, and presumably you should be making some bets in that of that type as well. Not investment advice, just sort of conceptual discussion.
Oh, that is a very interesting point. Now, from your perspective, whether it's focused on AI or other segments of the market, which parts do you find are overhyped and which are underhyped? There's certainly a big sort of bull versus bear debate in the market these days. And, throughout Q1, it's like Anthropic would have an announcement, a new Claude functionality, and this entire sector would drop 10, 20%. So, what segments of the market do you think are over and underhyped?
Yes. So in the first category, which is disruptive companies that will change the world, and it would be good to be an equity owner of, I would subscribe more to the Mike Moritz view of the world, the Sequoia GP view of the world, which is, don't talk to me about sectors and themes, just show me a great company that's doing something remarkable and is changing the world in a very profound way. And so without naming names, I think that's what you're looking for. You're looking for emerging category leading companies. I guess the equivalent would be you're looking for the Amazon, as Amazon is to retail and as Google is to search, you're trying to look for those new category leaders, for new emerging areas of human activity, which is the category leader in that space. And it is difficult, and you may need to be a bit diversified because we haven't yet had the browser wars or the mainframe operating system wars or the mobile system wars of these new emerging spaces. So, will it be OpenAI? Will it be Anthropic? Will it be some new LLM that we haven't even heard of yet? Just like Google displaced Inktomi. I don't know. So a level of diversification probably makes sense, but don't take the whole sector, because if you take the sector, you'll have all of the carnage of the people that get destroyed when the war occurs and the shakeout occurs. So that's sort of the disruptive part. So whatever you want to look at, digital finance wallets, custodians for digital assets, issuers of digital assets, whatever it is, large LLM models, middleware that connects enterprises to large LLM models, you're looking for the category leader, and you're trying to get in at a reasonable price with the assumption that they will, potentially be standalone public companies. On the other side of the coin, I think you can be a little bit more sector focused, because in general, large enterprises are bad at innovation and most of them do not succeed. So I think if you went back, 30 years ago, you could have bought a bundle of department stores confident that none of them would survive. The problem is it would have been a very long bet because they took a long time to die, but none of them exist today. I mean, we've got a handful like Nordstrom maybe that's doing a reasonable job, but where's JCPenney and, where's Sears and where's Macy's today? So I think it's a little bit easier to see who's going to be disrupted than it is to see who's going to win. But like I say, I'm not really a person that wants to bet on failure. So I don't short things myself, but I know a lot of people do. And I think if you were thoughtful, you could probably already name quite a large number of established types of players. Well, listen, this is not investment advice, but I look at utilities and I sort of say, in a world where you can bring your own generation and you can build state-of-the-art generation fit for purpose for the place where you need the energy, why would you think that a 100-year-old utility would win? Right. So if it wasn't for regulation, they'd all be bankrupt. They're pretty bad at what they do. I mean, here I live in California. The utilities here in California just burnt down the whole state. Whole cities burnt 10,000 sequoias to the ground that have been there for 2,000 and 3,000 years and killed hundreds of people in the process. What right do they have to continue to exist as companies were it not for the regulatory support that we provide them? And I think over the next 20 or 30 years, the model of utility generation in America will be profoundly different, and it will get cherry picked. So it's one of those things where we still have the US Postal Service, but not really for the things we really care about getting into someone else's hands quickly, efficiently, and easily. They become sort of the sender of communication of last resort for junk mail, and all the high value stuff we siphon off. So I think utility generation probably is going to end up looking like that, right? All of the really massive state-of-the-art generation will be held by new players, and the utilities will end up with, well, everyone needs some electricity, so they got to run a unprofitable transmission system for, all of the communities that don't justify a massive purpose-built state-of-the-art generation facility. Something like that. I'm making that up, so please don't quote me.
Well, with the goal of leaving a few more breadcrumbs for our listeners here, Matthew, prior to letting you go, I did want to put you on the spot a little bit. And from a long investment perspective, what would you say is your top investment theme for the next 5 years?
Yes. So I'm going to tell you, it's the two that we picked. I mean, we didn't do it without a lot of thought. We think intelligence itself is being digitalized, and that all by itself is a 50-year conversation that is going to ripple through everything we do. And whilst we can't predict exactly where we end up, we're going to end up in a very different place, and there's going to be an enormous amount of value unlocked and an enormous amount of value destroyed. So call that artificial intelligence, if you will, but it is a very broad field, and there's a lot of pieces to it. And then The digitalization of value, which is, where I think blockchain comes into play, the digitalization of value over the internet is bigger than the digitalization of communications and content. And we know all of the public market alpha of the last 30 years has been driven by internet companies. Well, and they were primarily digitalizing communications and content. Yep. The digitalization of value is much larger because finance and money and value is much larger than sharing information and content. And it's just as ubiquitous because we all transact all the time. So in our opinion, the digitalization of value and the arrival of digital finance is a bigger moment than the arrival of the internet was initially. And we don't yet know who those FANGs are. We hope that they have names like Coinbase and Kraken and Anchorage and Bitwise and Securitize. But what I'm pretty sure is the value is not going to get captured by BNP Paribas and JP Morgan. They've got too much legacy and they move too slowly.
Well, there you have it, folks. We're lucky enough to get some names out of you, Matthew, at the end there. So we did our job in terms of getting some ideas out there. So we really appreciate you coming on the show today to discuss two of the most innovative and exciting spaces in the market, AI and blockchain. And there's just so much to digest there. So we appreciate your ideas and explanations around these sectors.
Yeah, thank you, Julian. Thank you, Michael. I will reiterate that we are an RIA. None of this is investment advice. What we're trying to share is thought process, how to think about this. Hopefully your audience may have got one or two frames of reference to conceptualize what's going to happen. I could not be more excited. I actually believe we're entering the most exciting time of my life. And I know there will be challenges, and I know society is not fully prepared. But I think when you get back to the fundamentals, real human beings trying to accomplish things in their everyday life, we're going to unlock more value than any of us can imagine.
Good stuff. Well, thank you, Matthew, for coming on the show. We wish you the best of luck.
Great. And thank you for having me.
All right. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.